Good morning, everyone. Welcome to the room. As you know, trading futures does involve risk, not suitable for all investors. Information in the presentations for educational purposes, not a trade signal service, not intended to be financial advice. Happy Election Day to everyone. Election Day can mean a lot of different things, and there's not really a clear pattern that I've seen over the years on the Tuesday, whether it's midterm or presidential election. But there can be a little bit of a lull leading into it, kind of as we saw yesterday. And throughout the day, depending on what news transpires, the market can do a whole number of things. So just kind of keep one eye, one ear open for some curveballs this morning. At least that's kind of how I'm going into the day. Getting a couple other things going here, and we'll get the bell here in just a few seconds. Here we go. Next week, I will be at the Vegas Traders Expo for those that are going to be out there. Be sure to, I think, Tuesday morning. No, Wednesday morning is when I'll be presenting. So Tuesday, we'll do the trading room, and then I'm going to shoot over to Vegas. And then Wednesday morning, I won't be trading. I'll be at the expo. And so Tuesday evening, Tuesday afternoon, Wednesday, if you're around, be sure to stop by. I'll try to hang out at the expo and be around the trading session, or be around the live session rather on Wednesday. Let's see. So for those that are new to the room, thanks for tuning in. We'll kind of go over a whole lot of different things here this morning, and not sure what's going to transpire trade-wise. Sometimes the day of the news announcement, kind of leading up to it, is sort of the election day is kind of like the FOMC meeting announcement, where sometimes people wait until the results come out. So like the Wednesday FOMC day is pretty slow. And then once the announcement is revealed, then people kind of have more certainty. The market does not like uncertainty. So anytime we can do things to add certainty, whether good or bad, that's when we tend to get more of a trending environment. And again, that trend could be up or down, but having that certainty is what is really helpful to the market. One of the ways that I gauge the uncertainty level in the market is to look at the volatility index. And that's really helpful because it kind of gives us a picture of what is actually happening, and as does the market breadth and the advanced decline line. We'll talk about those here in a minute. Currently, for those that are familiar, breadth, advanced decline line are pretty much dead on flat, which means pretty balanced. Bulls and bears are sort of balanced. You've got people buying stocks, people selling stocks in the New York Stock Exchange. Those numbers are pretty even today, at least here at the open. Here we go. As my profit charts load. So the volatility index is really helpful because it gives us a picture of what is the actual fear and uncertainty in the markets. And if we go out to a 5-year chart, and if we flip back to the S&P quickly, we kind of did this last week. We can see that okay, we've had some dips in the S&P here, but for the most part, and we can even go to the SPX, get rid of the volume. We've had these dips in the S&P. We'll call it mid 15, right on start of 16, start of 2018, and then just lately, this last couple of weeks, we've had these bigger dips. And if we look at the volatility index, I want to see correlations between those spikes and the dips in the S&P. You see kind of mid 15, but then what happened in start of 16? We really didn't get a huge spike in the VIX. So once again, we'll go back to the S&P. If I hold my cursor over here, here was the first dip, sort of, I guess, towards the end of 15. And then in 2016, we had the start of 2016, we had a bigger dip, meaning we broke this swing low over here. But then I'll keep my cursor right on this same position. But if we go to the volatility index, well, the VIX did not make a new high. We did not break the corresponding swing high in the VIX. So that was a signal that, okay, the markets are not as weak as they seem. And then we go back to the S&P. Okay, what followed? Oh, hey, big bull run. So a lot of people, selling by fear, but the smarter folks who would be looking at things like the volatility index can use that as a way to say, well, maybe things aren't as bad as they seem. So as we come over here, we kind of have the same situation. We've got this spike in the VIX in the beginning of 2018. And as we come over to the S&P, again, here's the drop down in the start of the year. And now as we're in the last couple of weeks, notice that we haven't broken that swing low back here. And if we, once again, go back to the VIX, we can see, well, the VIX did not break this swing high. So maybe things aren't as bad as they seem as we compare it to the 15, 16 similar situation. So what would make that change? Well, if we were to break the swing low from the beginning of the year back here, if we were to break this swing low, then I'd want to see a corresponding move up in the VIX to break its swing high. So I'm not saying that we can't go lower from here, but what I'm going to be looking at is if we take out the swing low from the beginning of the year, whether it's in the next couple of weeks or towards the end of 2018 or even the start of 2019, I want to see a corresponding rise in the VIX that's higher and breaks the VIX's swing high from February 2018. So I'll keep my eye on that, and you should too, because it's helpful to, yes, follow along, but also kind of watch things for yourself and take in some data, look at the information, kind of put together your own hypothesis. And then as we discuss some of these things, or as you get together with, maybe a local meetup group, or at the Traders Expos, you meet some folks, or just chatting with people, if you've got a local mastermind is super helpful. They don't all, the people don't have to be traders. They don't even have to be close friends. If you just kind of connect with, a couple of people, and get together once a month, every other week, just get together and chat. Maybe you can have a couple specific topics to talk about, but it's just the power of getting like-minded, bright people together. I say like-minded, but you don't have to be like industry. and it's helpful to have people of different walks of life and things like that in there, different ages and things. I find that mastermind groups are very, very beneficial. So good way to kind of, we talk about thinking about the opposite, expecting the unexpected, always kind of trying to look at things differently. And a mastermind group is a really good way to do that. So as we kind of go from the top down daily, for those that probably are used to the weekly market analysis videos, you notice I didn't do a video last night. I'm finishing up some remodel in my kitchen, and so I've been trading the morning session, basically those 90 minutes, and then getting back to work on that, as well as prepping for the Traders Expo. So the weekly videos, market analysis, trade recaps, those will resume next week. And like I said, for those that'll be in Vegas, or they'll be doing a live stream too that I'll post on the homepage. So if you're not going to be in Vegas, I'm pretty sure you can catch the live stream on your computer. So as we get into the morning here, I've got the trading hours. I've got the Globex, so the 24 hours of data on. I like to get an idea of what was happening in the overnight. Where did we go? Didn't really have any big swings or major moves, so I just turn that off. And on the daily chart here, notice that we're still within the range of Friday. And so until we can get outside of Friday's range, we kind of had this situation last Tuesday, and the last the last two Tuesdays have kind of traded like this as well, where we had a bigger range on Monday, and then Tuesday was an inside day. Didn't really give us a lot of setups, especially last Tuesday. There wasn't a whole lot going on in the morning, and then kind of later in the day we turned into, at least last Tuesday, a pretty decent trend, but that trend was still within the prior day's range, so it made it a little bit tricky to really capitalize on any trades on the trend. So I find it helpful to get some context of where we're at, and you'll notice right here this morning we've sort of just gone straight up without any retracements. The first 15 minutes I kind of let things settle out and don't take any trades. And so by drawing from whatever we start our open at, a low, grabbing the first low or the first high, and kind of waiting for us to make the very first pullback is where I like to begin. That way we can have some anchor points established and begin to draw up our retracements. The market breadth and the advanced decline line not really changing too much, getting a little bit stronger here in the first 10-15 minutes, but really staying the same. Yesterday's high, a 43.75. I find that helpful to note. That's about right here. That can sometimes act as support as we move higher, but the bigger key is going to be 56.50s, and that's not too far away. If we can come up and break 56.50s, then we should be able to come up to 27.75s. That's the full retracement short. Last week I mentioned how when we're coming up like this, we're bouncing, I don't try and take or draw up a retracement on every single swing high. Like when we were down here at lows, I didn't, draw from the first swing high down to lows. And then, okay, well that one failed. So then, okay, let's draw the next swing high down to lows. Okay, well we've kind of stopped there temporarily. And then, oh, well, what about the next swing high down to lows? Okay, we have a little more room there. And then what about all the way at highs down to lows? And okay, we've got a little bit more room to go there. instead of trying to kind of pick and choose where we might stop, I just default to the full halfway back. Use that as the as sort of the target. And if the market does roll over and start selling off, then I'll come back afterward and say, okay, well, we didn't make it up to the full retracement. Where did we stop? Is there another swing high? And might that be what we're selling off, getting resistance at? And then you can use that as a target and take another trade in that direction. So in this case, short, and use that target. But what can happen is you end up sort of drawing all these lines on your chart, and you think, okay, well, here's a retracement. Well, the market has to stop there, and it doesn't. Then you say, okay, well, here's another retracement. Market has to stop there. Oh, well, it did temporarily, but it might not in the long term. And so you can kind of look at multiple retracements. Like if you look at the full halfway back short, and then you come over here and you look at one that's a little bit lower, like an anchor point here, that this one worked in the past. We had a retracement up here, whereas the full retracement didn't quite make it to its 50. We sort of sold off before that. So we can look at that trend or that pattern and say, okay, well, maybe we don't make it up to 75s exactly. So what does the swing low or swing high just below that look like? Okay, well, that also covers the larger one. They kind of overlap. And so then you can that's how you build your range or your box or the area of, okay, this is a resistance area, 2750s to 2775s. And so then you can be looking for shorts in and around this area, as opposed to being extremely rigid and either taking a blind limit at some other smaller level on the daily chart as opposed to the full, or just kind of taking stabs at shorts just because you think that the market is can't go any higher. So you can really get yourself in trouble by doing some of those things. So I know it's a little bit more abstract or advanced, some of that kind of relationship of the retracements to each other, but identifying the trend is important, as well as identifying the patterns of trade. How has the market been reacting? Some mornings will come down to a 50% and will bounce exactly at the 50, trade right to the negative 23, and then sell off and do it again and again and just continue beautifully, hit the 50, trade up to the target. Other days we might come close to it and then bounce even before we hit the 50. And so you can use those insights. That's the trading intuition that you're building as you're watching one market and trying to take in information. Those are the things that you pick up on, and then you can use that as a way to say, gosh, this market has been very difficult. There haven't been many pullbacks, and there have been a lot of fake outs. So I'm going to be very cautious. Or you can say, gosh, every single retracement here this morning is just coming right back to its 50 and bouncing. So I need to get moving on these and get more aggressive. And that can really transform your trading the more you kind of look for those kind of patterns, as opposed to just looking at price action and candlestick patterns and things like that. So at some point this morning, we will get a full retracement. But in the meantime, things are looking pretty strong. Last Tuesday, I go to 30-minute chart. It was after the session after our morning session, but we were talking of, since I didn't do a recap video, we were talking about how on the 30-minute chart you can use the prior days. I just have the trading hours only, and I'll use the swing lows and swing highs. And so we can come here and say, okay, high to low at the open last Tuesday, we broke the 61.8 in the first hour. So then what do? You draw the setup in the opposite direction. So that was a short from high to low. That failed. And so you can start by drawing long setups and look for a pullback to that 50%, not taking a blind limit because that's a very big level. The distance between the 50 and the 61 is, in this case, 9 points. So a 6-tick stop is obviously not going to keep you in that trade. And then, but you can look for a long setup at that level on the 512 tick chart. And so we hit that later in the day and then bounced from there. So this morning, pretty solid trend so far. Although sometimes when we have a strong first 30 minutes, that leads to a kind of a quiet morning because you have a big range at the open. I noticed this high tick at 42, and we've made a new high after that, so we could continue to make new highs. That's a good sign for the bulls. When we get a high tick, nicey tick that lines up with the high price, that is a sign that we could have a high for the day put in. And a lot of times if you get a high tick that lines up with a high price and a little double top, makes for an excellent short setup. I know a lot of you have seen us take that setup in the room, or vice versa. A double bottom leads to a nice long setup. Right at the open here, let me adjust my anchor point. After moving up in the first 10 minutes, now we kind of, you can come in here and see a few deeper pullbacks. They're not very big setups. Like this guy here, we're only talking barely 2 points. And so being so early in the day, I'm not super comfortable or I'm not super, I don't have a strong desire to take these little long setups up here just because, we're only 20 minutes in, we're going to make a deeper pullback. And when we do, then our reward to risk is going to be a lot greater. If we can take a long down here, then we have, a 40, we call it a 44s up to a 54. So that's 10 points of opportunity for the market to run. Not that the market can't go higher from where we're at. It always can. But when you're only 20 minutes into the day, you don't want to kind of get overly excited and feel like, oh, I missed the move of the day, and then take a bunch of trades or, take 2 stop outs back to back and then kind of, blow your bullets, use up all your bullets for the day. Yeah, Mike, that's so at the Chicago Expo, they had a little kind of workshop booth set up in the expo, and they had some panelists, or a handful of traders up there just kind of taking questions for a 30-minute section. And I mentioned it to the gal who kind of organizes the expo area that maybe we could do some kind of live trading, basically the trading room, what we're doing right now, only in person. I thought that would be kind of fun. We weren't really able to accommodate that for the Vegas Expo, at least with my speaking slot and then other speakers and whatnot and stuff happening in the expo. But that's definitely something that that could happen for a future expo, and that would be fun. They've done some like trading challenges where they put 2 traders up there, and you have a 30-minute or 45-minute period to trade and just kind of talk through your trading. But doing a a sort of instructive or walkthrough of just one person, I think is a little bit more effective as opposed to trying to compete with somebody else. I've done a handful of those with Infinity, and I did one with John Carter, and actually beat John. But it doesn't really mean a lot. One time you might beat someone, and then the next time they might beat you, but it's not really about beating them. It's about trading well and trading with good execution, so that sure, one time or two times you might get lucky taking a bad trade, but by repeating those habits over the long run, you're not going to be making good progress, as opposed to one or two times you might take a good trade and get unlucky. But if you continue trading in that way over the long run, then you'll see results. And that's, again, another very abstract concept that can be difficult for traders to grasp and be able to follow through on. I'm going to draw up this little short here, not because I necessarily like it as a short, just because it's kind of the most recent retracement, and I want to see it fail up here at the 61.8, or see us roll over and come further down to the 50%. If we keep going higher, it may not be till the first hour or so that we get a pullback to the 50%. One other thing I should note, and I think I talked about this 2 weeks ago, one of the things that I'll often do if we get really strong like this is to simply look for the high, like the major swing high. And when I say major, I just mean, I'm looking at a 30-minute chart, and what high and lows stick out. Okay, well, you got this low down here, and you have this high up here, then you have this low back here. Those are kind of the three major swing highs and swing lows. These in here, yeah, sure, they're important, but they're kind of minor, secondary, if you will. So I look for the major swing high, and come over to the daily chart, and we can see that, okay, yes, that swing high is the daily high from Friday. That's an important area. And so you can say, okay, 70, 27, 56, 50s, and putting a buy stop one tick above that, 56, 75s, is a great way to get in the market when we're moving really strong with a lot of momentum, when there's not a deeper pullback. It's kind of a modification, or it's the breakout method, what I call the breakout method. But you're not necessarily buying the high of the low bar. You're buying the breakout itself with the anticipation that we're going to push fast. We're going to move quickly through that high so that the market gets away from our entry. And then when we do pull back, we don't pull back as far. So that's one option if we continue moving higher here without any pullbacks. And I'm still using a 6-tick stop, so even if I do get taken out, not a big deal. In this situation, I'm also considering that, well, we do have this, we're close to the resistance up here. Notice I have this long drawn up. We did not make that pullback either. So right now we're just in the middle of these 250s, and that's typically a tough place to be. Notice this little spike here through the 61.8 on this short. It's not a very big spike, and if you took the short, 6 ticks would keep you in the trade. But those are just some things I like to pay attention to see how clean we are. Does the market come to the 50 and bounce, or in this case, we're just kind of knocking along that 50%. And that may be the trend for today, just because of with the election midterm stuff, people are kind of waiting to see who the winners are, and then gain some of that certainty, and then that helps the market move forward. Let's see what the NASDAQ's doing. Kind of the same thing, straight up with no real sizable pullback. You got to figure that at some point we're going to pull back. And when we do, one strategy for that, when we do, is to look for a break of a little bit bigger swing low, or a sign that maybe we're double topping and breaking down. And you can take a short and allow it to ride that short down to the next bigger long entry. So it's okay to go counter trend. You just want to make sure that you have a little bit of confirmation that the market is breaking down, so that you don't just try and short highs just because it's a high. So Wednesday morning is when I'll be, next Wednesday morning, a week from tomorrow, for those that'll be at the expo. For those that were in Chicago, I'm going to pull a few things from that presentation and then incorporate some new things as well. And always super fun to meet and chat with folks who are who we've spoken via email or one-on-one conversations. Always fun to meet in person, put a face to a name, and be able to chat more. So looking forward to that. Trading the overnight is always a little iffy, whether it's trading the futures because there's earnings coming out. Here's a low tick in the nicey tick. Sometimes that can lead to a bigger sell-off here. But when we go from a swing high right to a swing low, that can, meaning that the high was above the last swing high, and then a straight push down. That can be a quick move, like a quick following move, but I'm going to draw it up anyways. 49s is what that was. So yeah, quick back up to the retracements, and you got to be on the trigger. We'll see if that moves us down. 59s, 59. So yeah, Jack, I'm not a huge fan of trading overnight in general, whether it's trading the futures because there's an earnings announcement, or like this evening, as the election results come out, the futures markets are probably going to be a little sporadic, and I would not be surprised if we have a sizable gap tomorrow or some kind of gap from those results. But the traders who are trading that, it's very emotional, and so it's very difficult to trade with some sort of structure or process. So I would, if you're gonna do it, be very careful. I would trade anytime you're doing anything like that that's maybe against your typical trading regimen. I wouldn't say never do it, but just cut your position size down if you can. So if you're trading 2 contracts, trade it with 1. If you're trading 4, trade it with 2, because you're essentially saying, okay, my reward is going to be a lot greater, but my risk is also greater. At least that's what you're anticipating. So you can offset the risk, some of the risk, by cutting your position size in half. And that concept goes for anytime you're taking, uh, investing in something, whether it's a startup or giving someone some seed money or investing in, something like Bitcoin or any of that higher, more uncertainty, higher risk. Yeah, there's some higher return potential, but be limited with your funds that you issue or allocate, because the reward is typically higher, but the risk is also higher. So it's still good to assess and take some of those risks, but you just don't want to necessarily bet the farm unless you have a really good reason. So first 30-minute candle, pretty big, 16 points. That oftentimes leads to a sort of range-bound day. It's tough to have a first 30-minute candle that's 16 points and then continue on. Let's say you had 3 candles in a row of, we'll just call it 10 points. I mean, that's already a 30-point day. So we may end up in this range. I've marked the high and low here. And oftentimes what happens is you go from the top of the range down to the bottom of the range. So we'll see if this 49s does anything, see if it can even go halfway, let alone to the bottom of the range. So for now we wait. 46s, 46 and a quarter is where I have my first target here. So just the negative, whenever you're rounding, so like the negative 23, the target is 45/88. Well, 88's an odd number, so you got to move it to an even number and a quarter for the ES here. So even, quarter, halves, 3/4, evens. So rounding up, you're always rounding towards the 50% for your target. So rounding up to 46s and adding a quarter, so there it is, and using that as your target. When you're entering, you're always rounding away from the 50. So how I got 49s was that 49 and 38 cents is an odd number, so rounding down away from the 50 is 49 and a quarter, and then rounding, I subtract a tick or move another tick away, 49 evens. So that way if the market only goes to 49 and a quarter and your price is at 49 and a quarter, your entry on a live account, you're not going to get filled. Price has to trade through. I move my stop up here to 50s, 27.50s, just above the swing high here. So that limits some of my risk. Taking the first target is helpful to lock in a little bit of profit. And then obviously, since you take off that contract, you don't have that risk. And if the market comes back, you've already, instead of having a stop out on that contract or that half of the position, you've limited your risk by taking a profit instead. That's not a big profit, but it's something. In this case, 4 points, just shy of 4 points, and then tightening your stop at that point when the market breaks the swing low reduces the risk on the other part of the position, but keeps you in the trade. The idea is to stay in the trade as long as possible, and as long as it's going your way. Obviously, if it's going against you, you don't want to remove your stop and stay in it and say, well, it's going to come back, it's going to come back. But then as we start to break down like this, you can do a couple of things. You can move your stop above the next swing high. See how we made a low, we bounced, we made another low. So you can put it here at 47.50s, or you can trail the next 50% retracement. So this one hit its target, and this is what I like to do. Or if you had 4 contracts, you took 2 off, you could trail the last 2 in different ways. So, and this is what I do a lot. I'll trail one a little more tightly if I'm trading, and I've got a couple of contracts left after I took half off at the negative 23. Or even if you have 3, 3 is a good number. Take 1 off at the negative 23, then you have 2 to trail. So draw up the next retracement, from high to low, and you say, okay, well, if my stop is here at 47.50s, that's kind of right at the 50%. But if I put my stop above the 61.8 at 48.25, yeah, it adds another point, but it might keep me in the trade. That's kind of the failure point of the trade. So I always want to put my stops at the failure point. So if we don't have a swing high or a swing low in the middle of the sell-off, like this one's kind of down below, then just use the 61.8, throw your stop there at 48.25 is where I've got it, and that still puts me at a small gain on that half of the position, but it still leaves me the opportunity for the market to come up to the 50, tag it, roll over, and then continue on down. And the idea is to get those runners. You can do very well by taking profits at the first target and taking the second one off when you get stopped out. A couple of trades can really add up, a 4-pointer and then a 3-pointer and a 2-pointer. All of a sudden you're almost at 10 points on the day. Even if you have a stop out in there or a small loss, they can really add up nicely. So 48.25 is where I've got my stop here, and then now we're kind of getting into that full halfway back territory. And what does that look like? That's a 27.44. So I'm not necessarily going to close out the position at the long because I'm already in the short, but I keep that in mind, and it's definitely, I want to get my stop a little bit more tight as we get closer to that 50% long. Because I want to look for, okay, where is the recent swing high when we get down and touch it, if we do, and I want to get my stop above that right away, because as soon as that breaks and we start showing strength to the upside, you can get more people on board, and then all of a sudden the market's moving higher, and I want to be out as soon as I can identify a trend change. I don't know about you, but anyone who's using Gmail, the new, I guess it's not that new. They rolled it out at the beginning of the year, and everyone's converted now. But it's very slow. It's going through emails over the weekend and wasn't refreshing, and it just kind of drags, and use different browsers, and I've talked to some other people and talked to folks on Mac and I've got, trading platforms are on both my computers here are on PCs, or my trading stuff is on PCs. So, but yeah, not super impressed. So I'm going to get rid of this first tracement. Don't need that, but I am going to draw the full, because that's always helpful. You want to weigh the profit versus stop placement, and you don't want to give up too much. Like, you won't want to be so conservative with your stop that you leave it at break even when the market is 5 points ahead, because you could just take your profit on that part of the position for 5 points, put on a new position, and get stopped out and still be ahead. Where the risk comes is in the market not moving back, and if you get out for a profit and the market moves back but it doesn't fill you and you can't get in the trade again, then you might miss out on a little bit more. But I'd rather miss out on more than kind of put my stop way away from, like, have a huge stop. I don't think you really need to have 5, 6, 7 point of wiggle room for a trade. If it's gonna move, especially the ES, it's gonna move quickly. So here we made our test at the 50, and So I'm totally fine with keeping my stop at the 48.25, because if we move higher and start getting all messy in here, well, I don't want to be in this anyways. But you still, by being in the trade, you have the opportunity for profit, and that's, all it takes is a couple of trades where one, every fourth or fifth one, you get that runner, and then you get that extra 6, 7, 8 points that, even with one contract. If you're only trading 2 contracts, that's why I encourage people, rather than going to live sooner trading 1, you actually gain a lot of benefit by trading sim and trading 2, because you can practice managing the position, scaling out, that sort of thing. That's really helpful to build those skills, because the goal is not to trade one contract forever. It's to get to, at least get to 3. 3 is a good number. 3, 4, somewhere in that window. I'm not trading 10, 15 contracts. I have in the past, and I just find that it's everyone's risk tolerance is different. And I find that I don't trade as well trading 10, 15 as I would 6, 8, somewhere in that range seems to be the sweet spot where the losses don't affect you and the wins don't either. All right, so there's our push through 48.25. So about 4 points on the first half, and another point on the second half. So based on 2, risking essentially 3 points, making 5 on a trade that quote unquote, didn't really follow through. We made it to the first target, but didn't make it down to the 50% long. That's, I wouldn't call it a failed trade, but just a really non-eventful follow-through trade to get a decent couple of points out of it, and then move on to the next one is good. One thing, if you are trading on sim, one thing that I also recommend is, if you're going to place your order, let's say here you were shorting at 27, the number is 48.38, so you're going to round down to 48.25 and then subtract a tick, 48ths. If you're on sim, subtract another tick, 47.75, because what happens is on a live account, the market has to trade through your price. So if your order is at 48ths and the market touches 48ths, unless you get what we call a magic fill, where you're one of the first ones to get filled at that price exactly, which doesn't happen very often, then most live platforms will just fill you at the price. So if your order is hanging at 48.25, price touches 48.25, then you're going to get filled there. And you don't want to get kind of false readings with that. And so adding an extra tick on sim to account for that, I find to be helpful. So just a little trick if you're trading on sim and you want to make sure that your numbers are more accurate. So technically we're holding this 61.8 up here, but we've started a little trend of higher highs and higher lows. It does target the 50%, and if we get down there, great. You can't really care or let it bother you if you get taken out of a short and then the market ends up moving lower, because by definition, your stop is getting you out when the momentum changed, and that's what we have here, a momentum change. Albeit it might be temporary, but it's enough to start breaking some of these swing highs and change direction to where we could easily move higher from here. If we sell off, move down to the 50, well, then we just look for a long down here and have more room to move higher. Pretty solid little channel on the 30-minute chart. So it wouldn't be surprising if we kind of move in conjunction with the big body, big range first 30-minute candle. We could sort of move sideways towards the bottom of the channel. That's pretty common to see. This time of year, it's also helpful to kind of think about where you want to take your trading next year. Not necessarily to do a full yearly assessment just yet, but if there's some things you want to try or strategies you want to kind of polish up so that as you head into the next year, you've got some data to work with. You can use, because this time of year tends to be usually pretty decent for trading opportunities. It's a good way to test some things out on either on sim or live now. And then because as you get into, what happens is you get into December and then the latter part of the month, things really start slowing down. And if you're going to be testing strategies with low volume when there's really not a lot of activity, you can end up getting some bad data and just really not a lot to work with. And then you go into the new year and don't really have accurate numbers to base your decisions off of. And then really helpful to do kind of a year-end assessment. Go through your trades, look at the last couple of years if you have data on that. Kind of cross-reference, okay, well, this year we were in, this trend, and these things happened, and my P&L looked like this, so that you can kind of compare. Okay, am I only seeing profit in certain conditions, in trending markets, in range-bound markets? Then you can continue to be diligent in executing in those markets. So regardless of your strategy, it's important to be able to identify the trend and the change in trend. And the sooner you can do that, and I don't mean just coming into the day and setting a bias and sticking to it. I mean being able to read the market and pick out different things that are occurring that might lead to certain conditions. For example, the first 30-minute range here has kind of followed with this sideways period, a little bit of a lull. And so even just being able to make an assessment like that and have a read or have a hypothesis for the next 30 minutes of trade, or where would we have to go to exit this range and move back into a trending market? Okay, well, breaking today's high, which is only 3 or 4 points above us, but having those anchor points is really what can keep you out of bad, tough trades. Let's see what NASDAQ's doing. High tick here, another high tick. What do we got going? So market moving up, making high ticks, which you'd expect it to, since it's not the high of the day, expect it to continue through. So now we've broken the opposing without making it all the way to the 50%. I'm going to leave this up, the 50%, until we either touch the target, 2755s, which is above it's right at Friday's high, or till we hit the target, or till we break the 61.8. There's not really another anchor point to pull from down here. Healthcare is still doing pretty good, but and it's been one of the sectors that has been doing good all year, as opposed to some of the tech stuff, which was doing pretty good, and then now has kind of cycled through and sold off quite a bit. Rotating in and out sectors. It's amazing how much that first 30 minutes can tell you or give you to work off of. Yeah, you bet, Brad. So I was just talking about the healthcare sector and some of that staying pretty strong, but then other stocks like Google and Apple and Amazon kind of selling off. And what ends up happening if I'm like swing trading some of these, they pretty much cycle off my radar because I start by looking for stocks that are making 52-week highs. So let's go to Abbott, for example. And if we go to a 5-year chart, just kind of doing a simple scan throughout the week, just trying to find names that are making 52-week highs, and then I add them to my list, and then throughout the next couple of days or week, I'll wait for them to pull back, and I already know they're strong, so when they do pull back, I can look for an opportunity to get long again, or for the first time, and kind of ride it, trail underneath the swing lows until we make a bigger dip. And then when I get taken out, even something like Abbott here that has made a little bit kind of a two-leg pull back, bounced, pull back again. Now we're bouncing. I would just wait for an opportunity where we sort of break a swing high, pull back, or either break a swing high, maybe make a new high, and then pull back to re-enter. And then something like a Google, where you might be trading it long on a move higher, I just sort of don't trade it long until it resumes its uptrend, and usually that means it needs to make a new high. And instead, I'll just, rather than trying to short stocks coming off of highs, I'd rather just look for something that's already in a downtrend and weak, because they're often going to move stronger to the downside. In some cases, these bigger names, Google, Facebook, the FANG stocks, Netflix, Apple, Amazon, some of those, since they're so heavily traded, you can just trade off the price patterns and look for longs and shorts based on the most recent trend without them being at 52-week highs and lows. But that's generally how I go about it. Pull up a 52-week high and low list, revisit them throughout the course of the next couple days, and then when one is making a move, making a setup, I already know that it's strong because it showed up on my 52-week high and low scan, and then I can look for my entry into that particular stock as a way for assuming that the trend is going to resume. So, and swing trading is something I've always done. That's how I started trading, and I like it because it's very hands-off and takes a little bit more capital, but it doesn't require as much time and investment in sitting in front of the screen managing the positions. It can be very hands off. I usually enter my positions in the morning, and then I typically only exit them at the end of the day. I'll let the trade go to the end of the day and then see where it's at and close it out there. If I'm going to be gone or something like that, I just typically trail my stop as long as I can. Sometimes you can go months in a trade, which is your reward to risk when you get down to it is can be really, really good. 3-4 times your risk is very not easy, but is very common to get a trade that does that. Even 10x trailing swings. Like if you pictured this chart, well, this is a 30-minute chart, but if it was a daily chart and this was a couple months of data instead of just a couple of days, all of these swing lows, if I was just trailing my stop below swing lows, just keep riding it until you get taken out. So the same concepts as day trading, and I've developed them from my swing trading. Yeah, portfolio management is also a big part of it, Brad. And so if the market is doing one thing, if it's moving up in a very strong upward trend, I'm likely going to have more longs and get more long signals. If the market is moving down, I might have more shorts. If it's flat, I might be pretty even. I try and keep at least one short on at all times, and or one trade in the opposite. If the market is super, super bullish, you can usually still find one or two shorts and vice versa. Because when the market does pull back, I want to have a couple of trades that I'm already in so that when the market starts pulling back and people start jumping on board or jumping ship, I'm sort of already ahead of them, already in my trade. So kind of market going to sleep here. Again, big first 30-minute range typically leads to this kind of following hour or so, but a nice little bull flag sort of forming here. So this next 30-minute bar, not this current one, probably. Usually there's two sideways bars following a big body candle, but the next one, as we get into the latter part of the morning, might push us through highs, and that could start us into a bigger trend. So again, you blow through your bullets early, then you don't have any left. This week, we actually have FOMC meeting announcement on Thursday, so don't let that catch you off guard. Thursday it can be a strange week now. We got like kind of a lull day today waiting for the election stuff, and then tomorrow might be a lull into waiting for the Thursday announcement. So Friday might be the fireworks, Thursday afternoon, Friday. So don't, if you're not seeing anything, don't trade. Or, don't take a trade just because you feel like you have to. So better to get through a week where there's these kind of bigger announcements coming out just by observing, maybe taking a handful of sim trades, maybe taking one or two live trades, and not shooting yourself in the foot. And then we get into more of a time of certainty. That would probably be a really good way to break down the year, periods of uncertainty and certainty, and that can help really solidify good trading opportunities, good periods to be trading versus bad. The holidays, Christmas time, people are generally in better moods. That's typically a time of more comfort and certainty, so the market tends to get a lift into the Christmas holiday. Now coming down to the 50% and not stopping at it initially here, low tick down here. going all the way to 61.8. We can, this full or this opposing, very messy, trading through it again, touching it. If we draw the next retracement from there, we can end up with this little range where we have the short above us and then the long below us. This is a really good example of why I don't like to put a blind limit on trades where the distance between the 50 and the 61.8 is larger than 6 ticks, because my stop would have been kind of right in the middle. If I had a blind limit, it would have been stopped out before the trade even had any opportunity to do anything. So let it come down to the 50. Maybe it trades through, gets a little messy like this, trades all the way to 61.8. Maybe we bounce around here, and then we have an opportunity to take a long from lows to a smaller high. And typically, what ends up happening, see as I draw up this retracement, the 50% still ends up being around the daily 50%. Like the smaller one in the 512, the entries end up being pretty close to each other. Only the risk is less because you've already seen the market stop at that level. So may get something like that. We may not. We may come up to the 50% here short and sell off, but the long has, I consider this traded now, meaning if we come up to the short, the long is already in play. If we break the if we break the long, the 61.8 sell off further, then a short would be valid. And then you could ride that short, like I said earlier, down to the bottom of the first 30-minute range. So top to bottom, bottom to top, you get those kind of patterns. You don't often get a day where the market moves. So we've established now, not only is this the first 30-minute range high and low, this is also the first hour's high and low. You typically don't get a market that will go above the first hour's high and then turn around and go all the way below the first hour's low. It does happen, but those days are a little bit rare and they're very tricky days. Usually there's some kind of either news coming out or something screwy happening. And so today could be one of those days. But if we break to the upside, I would expect us to sort of trend that way into the close. And if we break to the downside, I'd expect us to trend that way into the close. But again, I wouldn't be surprised if we just kind of close near the open, maybe kind of a doji day or something like that, just because people seem to be waiting for the election results. So the longs trading is where it gets a little tricky. You can draw up this little long here. Again, right at the 50%. Grab it there, had it. We'll call the 44s. The short did not trade yet. The long is in play. We didn't really break any sort of swing high back here, but the 44s, it's a valid long. We did have this low tick down here, but there's not a lot here. We're kind of in the middle of the range, so I consider it higher risk. But at the halfway back of the day, at about the hour mark, there's typically some sort of a reaction. If we fail, there should be a good reaction to the downside. If this moves higher, then we should get some reaction here to the upside. And again, pretty small. You can see this candle didn't actually turn red, but it did pull back and trade one tick through 44s to get that fill. And see how the 50s they line up here. The smaller one lines up with the bigger 50, so you're not really missing out on anything. And even if it was up a point higher, yeah, you're still lowering your risk on the trade. So I'm going to want to be a little bit aggressive here with stop placement because this short above us. I don't want us to turn around and just blow through lows. So this isn't really a swing low. 43. What if I draw the full? So I'm going to draw the full here, and okay, this is a little more helpful. Good. Okay, now we're basically through, and that puts our stop 43. We'll go 43.50. So that's one tick below. Good, one tick below sort of the entry candle. And I'm going to trail the full here. So 43.50, move it up to 43.75. Now that we broke the short, that's a very good sign. And we'll see if we can get back up to highs. But I'm going to trail the full for now. So I'm going to trail this. When I say the full, I mean the full low to high. And I'm just going to get rid of this smaller one, the entry one. But see, if you were looking at that after hours, you wouldn't necessarily see that. It's not always as clear, so it is really helpful to be here during market hours, even if you are sim trading. So stop at 43.75s. I'm just going to keep bringing this up. Oh, I should have also said that the first target using the opposing short, they kind of lined up here. It was a 45. What was it? 75 is what I think I got filled at. So 45.75 was my first target. I just kind of the long lined up with the short. And again, just rounding down, subtracting a tick. 45.75. Usually it's, somewhere, try to be around 2 points or so, 3 points if I can. But the idea is not to get the home run on that first target. The first target is like the easy, smaller win. Market doesn't have to move as far. Now that we're kind of going straight up, so 43 and a quarter, or 44 and a quarter, that's a ways away. Take one contract and put it up here, 47.50. And we touched that already, but I'll put it at 47 and a quarter. Yep, there. So there's one. So with one contract, or let's say you had 3, taking one off at the target, the first target, and then being 2 different stops. One stop trailing the 61.8, and then one stop trailing each candle's low. That's what I did there on sort of the first half off at the target, the half that's left trailing each candle's low, and it was a little bit lower than that, 47 and a quarter, and then the remaining, now my remaining quarter of the initial position, I've just got my stop at 44 and a quarter, and I'll just leave it there and see if we can come up to somewhere near highs or through highs. And I'll put this recording this afternoon in the dashboard so you can go back and review it. I know sometimes some of this stuff happens fast, and especially some of the smaller retracements, you'd be drawing it up and clicking on the dome, and it's like boom, all in 3 or 4 seconds. It can happen quick. So the more familiar you are, the more you practice on sim, get familiar with your dome and your charts, that definitely helps your trading. Your eyes are trained to lock into different spots on the chart. Keeping your screen clean is really helpful for that. And also I've got my anchor points to lock to open, high, low, close, or maybe even high and low. I have it set so that I can just kind of click near the high and it locks on here. But sometimes close is close enough. So all right, so let's go over this one again because it was kind of happening quick. So started by drawing the full retracement on the day, trading hours only, low to high. And then I said, okay, well, the distance between this 50 and 61.8, I'm going to get rid of this here. I've got my 44.25. I'm going to get rid of this just for now. And if this breaks the swing high up here, I'll move my stop underneath this swing low. All right, so back to the trade. So the long distance between the 50 and the 61.8 was bigger than 6 ticks. So I wanted to let it trade first. Let the 50 trade. In this case, we were traded all the way down to 61.8. And they say, okay, I want to take the first long setup after that. So take from lows, and I'm drawing up to this swing high here. And that happened to be basically a 44.25. Let me hide this. Remove the big one. So 40 or 44, but I had it at a quarter. No, I had it at 44s. So rounding up 43.63, rounding up 43.75, and then adding a tick. That was 44s, and then this little candle here didn't actually turn red, but it did pull back to that 50%. So now you can see if I put the bigger 50 back, it's amazing how fast you forget forget about your trades when you train your brain to do that. So you can see like this first 512, very small setup, lines up sort of with the bigger 50, but it just happens to be the first setup after the 50 traded. And then the opposing short did not trade either. That was up here. So that didn't trade yet before the long traded. We moved up. The short didn't touch. We pulled back to the long first. So that confirmed that the long was valid. If we would have come up and touched the short first, then you can't take the long because the short already traded. So in this case, we made a move up, pulled back to the long first, and then that put the long in play. 44.25 is my stop still. Not quite a double top up here, but not the prettiest looking chart either. So that's how I use the very first long setup after the bigger long has traded to get into the trade. And then I'll still use the target of the 50 on the bigger setup, negative 23 up here, as sort of my longer term target to see if I can trail. If we draw the full opposing from highs down to lows, you can see the 61.8 has broken. So that's why I kept my stop. That's why I have my stop at the full retracement below the 61.8, because the short failed, which means we should get a reaction at the long. And if you could use this as your first long entry after the bigger 50%. The 27, 43, 75s trades, we get a bounce, we break the swing high, we pull back to the 50%. Same thing. You can use 45, 75s as your entry. Let it come back here and see if that takes us higher. So I've got my stop below this 61.8 because that would be sort of the failure of this long. So we'll leave that up like that, and that way you can see if the long is going to get a reaction before you actually place your trade. So I'm always looking for where is the failure point, and that's where I want to try and place my stop. And if the market starts moving quickly, then you can just start trailing each candle, because you want to lock in those runs, those quicker profits without it coming back on you. I'm not so concerned about getting out at highs or getting in at the low. I'd rather get some confirmation and get in at a lower risk point. And it's back to waiting. You can see how this big channel, or sideways, I'll put a rectangle over it, area here is sort of where we're spending most of our time, sort of the bull flag. So we need to get above that if we want to get some momentum going. And this is a common pattern here in the 30-minute, where you've got a big body candle, an inside small candle that stays in like the top third, and then the third candle dips down a little further and then rallies, and the next candle breaks out. So we'll see if that trend holds. Then, knowing that, it's also important to know that when you have a pattern that you see a lot, that's common, if that pattern fails, then you typically get a strong move in the other direction. So that's something to prepare for too. If you get a hammer and then that hammer fails, all those people who were looking at it saying, oh, this is a hammer, this is going to be a bull move off of this, when it fails, then you typically get a stronger bear move, because you have both the longs getting stopped out, and then that accelerates, and new shorts, and then those two kind of compound each other and accelerate. So this swing low down here is at 27.45s. It's so close to the 61.8. Like if I move my stop up 2 ticks from 44.25 to 44.75s, it's such a small move that it really doesn't make much of a difference. You got to ask yourself, okay, if I get stopped out here and then it moves higher, versus giving it an extra 2 ticks of wiggle room and get stopped out, am I really going to care? No, not really. I'd be a little more upset if it came, stopped me out, ticked me out, and then moved higher than I would if I got stopped out 2 ticks lower. I'm not going to really go back and say, dang, I wish I had moved my stop 2 ticks up. So I'm just going to leave it at 44.25. Not expecting much here, especially because the short over here that we just saw traded through the 61.8, really through the 61.8, and then add it, and then traded down. So like the short ended up working out to the downside, but it was really messy. So this could end up stopping me out back here, retesting the 50 and then moving higher. But that's why you take some off at the first target. That's why when you get a straight up run like this, you take a little bit off because you want to capitalize on those opportunities. So I think we'll leave it at that for today. Some good stuff in here, even though a little bit slower today, but still, two winning trades and 2 out of 2, so that's good. And some good stuff to good market structure, like the way the market is moving and behaving. Yes, this short was a little bit messy and dirty, but there's still some good stuff to take away from that, and different patterns that you can use, that you can look for to use in your favor. So if you are long, I'm looking for a move through highs to new highs, and especially this 27.56.50s sometime later today. Otherwise, as long as we're within this first 30-minute range, first hour's range, I wouldn't expect much to occur. So we're close to highs, so we have a good shot to get there. If we come up and tag this 51.75 and sell off, then I would definitely look for us to move down to the 36 area, 27.36. So this week I'll be a little bit, probably be a little more than 24 hours to get back to any emails. I'm finishing up a kitchen remodel, and then also getting ready for the expo next week. So a ton of stuff going on, and look forward to seeing some of you in Vegas next week. We'll still do the live trading room here Tuesday morning. And if you're going to be in Vegas or catching it online, I'll post that link as well. So I hope everyone has a great day, and we will talk to you soon.